So of course we're all interested in learning how can we save taxes under this new tax code. An important fact to remember is that these lower individual tax rates are really only effective until the end of 2025. So we have a golden opportunity to be plotting a Roth conversion strategy. Take some of those pre-tax dollars that you have in your IRAs and 401ks and be converting them into tax-free Roth IRA dollars during this window of time. Another strategy is, think about grouping your itemizable deductions so that you are itemizing one year and then taking a standard in the alternate year and back and forth. And so a couple ways you could do that. To the extent you can control your medical expenses, think about really being deliberate and consolidating those medical costs into one calendar year. Property taxes, you could pay, say, 2 years of assessed property taxes in one calendar year. Charitable giving, you could alternate charitable giving, give more heavily in one year, more lightly in the other year, or you could even contribute to set up a donor-advised fund and contribute to it. You control the fund, you get a tax deduction for however much you put into the donor-advised fund, and then that donor-advised fund can continue to ratably year over year distribute the money you want to the charity of your choice. If you're over 70 and a half, please take advantage of the qualified charitable distribution rules. Especially if you're not itemizing, you're not getting any tax benefit for your charitable giving. But the IRS says if you give some portion of your required minimum distribution directly to the charity of your choice, don't take possession of it first, then we don't have to include that amount on your tax return as taxable income. So it's a great way to save yourself some taxes. And lastly, I'm going to suggest that you look at and update your beneficiary forms on your pre-tax accounts. Again, your IRAs, your 401ks. One change to the tax code is that now kiddie tax rates match trust tax rates. So that means for kids, minors that have investment income over $12,500, it's now going to be taxed at a whopping 37%. Why this matters to you is that if your beneficiary forms are not properly completed and you inadvertently leave those pre-tax dollars to, say, a grandchild, a minor, 37% of your hard-earned dollars are going to be going to the Internal Revenue Service. So really important to keep that in mind. So, my encouragement to you is to use 2018 to be proactive. Really take a fresh look at your tax strategies and be deliberate in thinking how can you use these lower rates to your advantage. Of course, feel free to call us, email, visit our website. If you'd like more information, we're here to help.